Hello, this is Mike Swanson. I run the website WallStreetWindow.com, and what you're watching is video 4 in a series of videos I'm calling Stock Trading 101. Now, what I want to talk about today are technical indicators. They're a key tool to use to invest or trade in the market. It doesn't matter if you're using 1-minute time frames, 5-minute time frames, 60-minute time frames, or looking to hold things for years. They're useful tools to figure out good entry points, and there's many indicators out there. So, and there's different types of indicators. And what I'm going to do in this video and perhaps the rest of the series is show you my favorite indicators. And we're going to start today with a series of indicators called oscillators. Now, let me share you my screen and give you an idea why I think it's an imperative to understand at least a couple indicators. You don't need to know how every indicator works. There's hundreds of these things. I don't know how they all work. And you don't even need to use very many indicators. In fact, you're better off only using a couple, and that's why I'm going to focus on only a couple. So let me share you my screen. And this is a little Robinhood account that I've got that I opened up a few years ago just to see what Robinhood was about. I got accounts much bigger than this, and I hardly ever even use this account. But I just want to point out one thing to you, that this is what I see when I log into the account. It's showing me the 1-day movement in my account. And one of the positions I own is SFL. That's a stock. And it defaults to showing me 1 day's worth of activity, a price chart. And what this does is it makes it so people who use Robinhood, their attention is focused on that. And then if they think, well, I want to know what happened over 3 months, they can see 3 months, 1 year, 5 years, and so forth. But they're only seeing these price activities, and generally they're being forced to focus on short term. This is not a way to make good decisions in the markets at all. And these charts that they show you have zero indicators on them, none. That's why I will repeat what I did say at the beginning of this series, that these trading apps such as Robinhood, with very little information on them, it's awful, because it's really, you can't make good decisions with this, and therefore I think it's causing people to make bad decisions or engage in herd-like behavior, which is not what you want to do at market tops or at market bottoms, when people tend to panic and sell in mass. You want to be a buyer when the masses panic, and a seller when they get overly excited, or at least more cautious. So that's how indicators can help. And let's talk about what are called oscillator indicators. Let me show you one of them right here. One of my favorite indicators. It's the indicator at the top, and what you're looking at here is an hourly chart of the S&P 500 in February and early March 2021. And the indicator at the top are the slow stochastics indicator. And it's designed to give overbought and oversold readings. And when it's above 80, it signals overbought. And then when it crosses back down below 80, it then gives a sell signal. It says, okay, we were overbought, now we're selling. So today, as I'm doing this video, this indicator gave a sell signal when the S&P 500 fell below 3880, and on the close, it fell below 3880. So if you want to trade based on that, you would then take that as a signal to do some selling, or to actually bet against the S&P 500 if you wanted to do that. However, one caveat about that, those type of readings do not work when you are in a giant stock market rally. So the stock market has been in a big rally since April of 2020. And if you were to use this to sell or try to short the market, you know, these overbought and drop below 80 readings, you would have taken a lot of bad trading decisions. However, when the market shifts into going into a correction, this becomes a great indicator to use to take short positions. And when you are in one of those powerful uptrends, it's a good indicator to use to buy dips. So how do you buy the dip? When the indicator falls below 20 and then crosses back above 20. And you can take positions by buying then and putting stops on the most recent low until that stops working. That's a, you know, now we're using hourly charts. That's a way to do trades based on an hourly time frame. If you're more of a long-term investor, then you'd want to be using daily or weekly charts. But the same basic concept applies. It's an indicator designed to give you very easy to see and very easy to recognize sell signals and buy signals. Now, I'm not going to go into how the indicator is calculated. It's basically looking at the price momentum that's going on to the upside and the downside and comparing it to recent history. And it's one of my favorite indicators to use. What I'm going to do is include a link to an article that clearly explains the math behind the indicator, goes into more detail about it, and so forth. But I'm just here to try to introduce this to you and to point out that it's not available on Robinhood. So if you want to use it, you got to use something like stockcharts.com, which has a free level service and a pay level service. I have no affiliation with them. In fact, I've had some bad dealings with someone affiliated with this company that, you know, I shouldn't have even said that, but it's nothing I did and everything's settled. But anyway, it's I shouldn't have mentioned that. Oh well, it's not important. But such bad dealings, I'm recommending them. That's the point I was trying to make. So, but also freestockcharts.com is another alternative. But there's another. So there's all kinds of indicators that are called oscillators. This one is my favorite. It's the easiest one to use, and you can find others, but I'm just going to show you mine favorites. And let me point out another second indicator in the oscillator family, and that's called the Wilder's RSI indicator. So I have it on this daily NASDAQ chart here. Again, that's the March 2020 bottom, and now it's March 2021 as I'm doing this video. It's got the same concept. Overbought readings are when this indicator gets 270, oversold below 30. This time I'm using a daily chart, and that's the only, I kind of use this to look at very long-term signals. So what's interesting is last year in September, that RSI indicator on the actual price level of that indicator, the actual reading hit a high not seen in decades. So that was a very significant signal. You know, it wasn't as extreme for the S&P or the Dow. The Dow did something similar in 2018, and the market immediately fell 10% early that year, and what was an event. This time, when it hit an extreme on Labor Day, the markets fell roughly 10% too. It doesn't look like a big drop on this chart because it then went up higher, but it was a 10% decline. And, you know, and it's useful to know, hey, we're overbought. Risks are now that a decline's coming. And we got overbought again, not as extreme, but in December and once again in January. So it's something I like to look at these long-term trends, and I'll link to an article that explains this indicator. And it also can be used to the downside. So we flip, now we're looking at a chart of the US dollar index. The US dollar index has actually, I believe, been in a bear market. If you go back to my previous video about the market cycles, I define a bear market as a market trading below the 150 and the 200-day moving averages, with those indicators acting as resistance. As you can see, the US dollar index has been below both of those moving averages now since May. So I believe it's in a bear market. And what happens in bear markets? You do get oversold conditions, but they don't lead to massive rallies, especially not in currencies. Instead, they tend to lead to pauses that last in the currency market. The pattern is a pause for a couple weeks or a couple months, then a move down. So in August, the RSI went below 30. And just as the NASDAQ made an extreme on Labor Day, this RSI reading below 30 for the US dollar index was actually the lowest reading in several decades too. So it's very significant. We made note of that. I did, at least. And but we did not get a massive rally. Instead, the US dollar index just kind of floated around to work off that oversold reading. Notice it got back 270 towards the end of September. Didn't actually get through it, but it back up to it. That was a signal to say, hey, this rally here is probably about done, the bounce more, so to speak, than a real rally. And it did peak out, and the dollar index went lower, went from 94 down to 89 by New Year's. And once again, it came into New Year's after the RSI got below 30 and kind of hovered around it. So that was saying, hey, we're oversold now. Not as oversold as we were in August, but we are oversold. And the US dollar index since then has been, floating, basically working off those oversold conditions. I don't think it has much upside. Possibly it could get to 92, hit the 150-day moving average, but I have no expectation of a giant dollar rally. My expectation is the way things stand now is it will work off this condition and be going lower this spring. But anyway, these are two important indicators. Now, without these indicators, I would have no idea that the markets reached extreme conditions with the dollar index in August, or the S&P or the NASDAQ on Labor Day last year. I would have no idea of that. No idea of these things if I was simply looking at daily price swings on Robinhood. And so that's why these sort of tools and getting beyond the apps that have no information on them is critical if you want to be on top of these markets. And there's no reason not to be serious about this game if you want to be into trading and investing, because there's so much opportunity if you are one of the people willing to do the work, because so many people are not, especially when you've had a giant stock market rally. That tends to attract people who are new to this, people who don't really know what they're doing, and they end up getting into herds, and it's just typical of what happens very late in a rally or even a bull market. And I think that's what we have been seeing over the past couple months with stories such as GameStop, the explosion in crypto, and then the top in Bitcoin, where it fades 20% from the recent high. All warning signs that stock market volatility as a whole is likely to come. And I believe that's where we are in these markets. And indicators like this are going to be very important to navigate, especially the short term. When you have more stock market volatility, you're going to see this stochastics indicator swing more from overbought to oversold conditions on these hourly charts than you would normally. In a giant bull rally like we saw from April to say, recently, the indicator can stay above 80 for days. You can actually see how it did that in early February. But when you're in a correction, which I think we're starting or heading into, we'll see. I can be wrong, because remember the video I did earlier where I said there's three basic trends to a market, three patterns, and that's all you really need to know. What are they? Uptrends, where a market's making higher highs, higher lows. Downtrends, lower lows, lower highs. Well, that's why the overbought readings can be so big in a downtrend, because you get lower highs and you can get entry points to short or take money off the table, take some profits out on rallies if you're too invested and want to reduce using this. However, that third trend is another trend, and that's sideways, sideways, sideways. And that can be a very tricky trend. But this indicator is still useful because in a sideways market, what ends up happening is you do get oversold readings that are good buy points, then overbought readings that are good to get out. So you get a range bound market. So this indicator is useful, and so is RSI for those type of trading conditions. So we'll talk about some more indicators in the next video, and I'll be talking with you later. Oh, one thing about the RSI, this is RSI, those three letters, Wilder's RSI. He's the guy who invented it. I'm going to link to the Wikipedia entry. I repeat that because there's another indicator we're going to have to talk about that's perhaps, I believe, the most important indicator. That's relative strength. That's much different than the relative strength index, which is what RSI stands for. Relative strength is a whole different concept. We'll be doing a video about that. Perhaps the most important concept, period, when it comes to knowing what to invest in, whether that's ETFs, stocks, funds, whatever the case. Perhaps the most important concept there is to know. So we'll be talking with you later.